We're going shopping for consumer goods dividends on this CG edition of Industry Focus. Greetings, fools. I am Sean O'Reilly here in studio at Fool headquarters in Alexandria, Virginia. It is Tuesday, November 17th, and this week is Dividend Week on Industry Focus. Vincent Shen is out today, and filling in for him and joining us on the phone from the Windy City, Chicago, Illinois, is Motley Fool contributor Adam Levine Weinberg. Morning, Adam, and how is it going?
I'm doing well. How are you, Sean?
Not too shabby. I got my coffee, got my water, ready to talk some dividends. It's all good.
That sounds great.
So, Adam, I talked to you a few days ago about today's show, and once again, thanks for filling in for Vince. And you're willing to dive right into the carnage of the retail sector for some reason I'll never understand. You picked Macy's for a great consumer sector dividend stock, which I happen to agree with, and we'll get into the reasons why in a few. Before we get into the nitty-gritty of Macy's as an income stock, can you just give listeners some perspective as to what's been going on in the retail sector? Because last week alone was a bloodbath.
Yeah, that's right, Sean. Retail stocks really got hit hard last week, and Macy's was definitely one of the big reasons for that. Macy's stock peaked in mid-July at $73.61. But since then, it's fallen by nearly 50%, and as of this morning, it's below $39. So a lot of that drop has happened just in the last week or two after its Q3 earnings, which were already expected to be pretty bad, were even worse than that. And the company is seeing strong, big sales declines. But the result of this is that the quarterly dividend is still 36 cents. And so the annual yield, which in the middle of July was a little under 2%, is now 3.7%. And that really makes Macy's an intriguing stock, at least for dividend investors.
Yeah, that is just crazy because that's more than a 30-year treasury right now. I mean, these are higher than bonds in the U.S. government. So what's going on with the business? Because, you and I did you were very gracious enough to call in a number of months ago, and we talked about Macy's again, then as well. And we both, I think their returns on equity, their shift to doing the online and the stores, it was all just awesome. They were clearly the strongest player, especially compared to like a JCPenney or a Sears. What's going on with the fundamentals? Because long term, I think the story's intact.
Yeah, so obviously you wouldn't want to invest in Macy's just because of the high dividend yields if you really thought that the business was in grave danger. Because sooner or later, if you're not making money, you have to cut the dividend. And then as an income investor, you're out in the cold. There's no guarantees to the dividend. The company can stop it at any time. So looking at Macy's, last quarter, their comparable store sales, so that's sales in stores that have been open for at least a year, declined 3.6% from the prior year quarter. And Macy's is expecting another decline on comparable sales for about 2% across the full year. So that's definitely not good. And Macy's has definitely seen a trend in the past 2 to 3 years of slowing comparable store sales gains. But this is the first time in quite a while, really since the Great Recession, that you've had a year-long significant decline in comp sales. On a year-to-date basis, Macy's EPS is $1.56 or $1.76, excluding some asset impairments. And that's down year over year. Last year it was $2 and a penny. And Macy's current guidance for the full year implies that you'll see this double-digit decline continue into the fourth quarter, again, excluding any gains from asset sales or special items. But you have to put this in the broader context because Macy's is coming off of a 6-year streak of double-digit EPS growth. So it's not like this is a company, like you mentioned, Sears, JCPenney, where there's been a lot of struggles. And there, a few bad quarters, could be a really bad sign. For Macy's, the company's basically been doing well until this year. And so it's worth looking beneath the surface to see why it's not doing well in 2015 and whether it might be able to recover.
Yeah, so they've got this shift to where they're trying to meet consumers in cyberspace as well. They built that huge distribution facility, which, as I understand it, and I've talked about it before, they built it in Oklahoma, and I'm pretty darn sure it rivals an Amazon warehouse. Like, it's top of the line. It cost them $300-400 million. It was it. Is online sales balancing these declines in physical stores at all?
So Macy's couple of years ago, stopped reporting its online sales separately. It had for a long time just reported the growth numbers for online sales without necessarily breaking out the exact dollar amount. But as of a few years ago, they were already at $2 billion and rising, by at least 20% a year. And in a lot of years, they were rising by 40%. So they were actually growing their online business faster than Amazon for quite some time.
That's an achievement in itself, I would think.
Yeah, and so that's definitely a big business for them, but it's still smaller than the retail stores. And the comp sales figures that I was discussing earlier, that actually includes the online. So you can bet that the online is still growing at a healthy clip, and just the retail is declining even faster. And so that's creating some need to kind of rebalance and figure out a new strategy to get the most value out of the stores that are in the network right now.
So comps are dropping. They're projecting a decline in earnings for this year. What are they doing to recover?
So Macy's is going after this with a multi-pronged strategy. So the first thing is they're starting to explore some new growth avenues beyond the traditional department store and even beyond the online component of its traditional department store business. So one thing that they're doing is they bought the Bluemercury chain, which is sort of luxury fashion or beauty stores, more boutique size, so quite small compared to a department store. And they're building more of those standalone Bluemercury stores, and at the same time, they're putting Bluemercury boutiques into existing Macy's department stores to make better use of space and to boost sales in the beauty department of each Macy's store. They're also testing Macy's Backstage, which is a new off-price concept. So it's like a TJ Maxx or a Nordstrom Rack.
I was about to say that's reminiscent of Nordstrom's Nordstrom Rack, and that's been a huge success. So,
yeah, and Macy's has already been in that business to some extent because they also own the Bloomingdale's chain, which is upscale relative to Macy's, and Bloomingdale's has a chain of outlet stores. So Macy's is trying to sort of move that more into the mass market now. And it's just a test at the moment, but they are really talking about rolling that out more broadly over the next few years. And Macy's is even testing an e-commerce joint venture in China. So they have a bunch of different things that they're trying, which will hopefully add more growth. At the same time, they also need to focus on getting costs down to be more in line with the sales they're seeing today. So the company announced last week as part of its earnings report that they're cutting their SG&A spending by about $500 million relative to their prior plan, and that'll be implemented by 2018. So you'll see incremental improvements in their selling costs over the next few years. And as part of that, they're closing 35 to 40 stores in early 2016 and plan to continue closing stores that are underperforming.
Now, those are essentially, sorry to interrupt, just low traffic, unprofitable stores, obviously not the big ones in urban areas.
Right. That's true for the most part. There's some stores in urban areas where they're closing the store not because it's unprofitable, but because the real estate is so valuable that they can make more money by selling the building to someone who wants to redevelop it.
Yeah. But
in most cases, yeah, the stores that are closing are the ones that are in the lower performing malls where there's just less traffic. Maybe these are malls where JCPenney or Sears had a store which closed, and so now there's fewer people coming to the mall. And there's been a problem in the U.S. for quite some time that there's just too many malls relative to how many people want to go to the mall these days. And so this is just a process that's going to continue for a while with, paring down to a number of stores that's more in line with today's reality, where you don't actually need to go to the store for every single purchase. Some things you might just want to buy online.
Got it. Before we move on and going along with this week's income-focused theme, I wanted to point our listeners to a special article written by 5 industry-focused contributors detailing their top picks for dividend stocks. Just head to dividends.fool.com to learn our picks for the best dividend stocks of 2016. Once again, that's dividends.fool.com. So, Adam, getting back to Macy's, I was talking a little bit about the dividend sustainability in the context of the cost cuts and everything, and actually their growth potential, because if they aren't growing, that dividend will not last for long.
Sure. So if you look at the annual payout, it's now $1.44, and that's up from just 20 cents during the Great Recession. So you can see that Macy's really has been increasing its dividend quite rapidly in the past few years. So $1.44 is about 40% of Macy's projected EPS for this year, excluding any asset sale gains or special items. So that's a pretty good payout ratio. It means that you're getting a good proportion of the income, but it's not so high that you'd have to worry that a small blip in earnings would make the dividend too high to afford for Macy's. On a cash basis, Macy's has generated operating cash flow of about $2.2 billion over the past 12 months, and the current dividend payout comes to roughly $450 million annually. So this means that Macy's has really plenty of cash to cover its planned capital expenditures, which it's reducing to under $1 billion a year going forward, and still have a lot of money left over for dividends and also for some share buybacks. And just like if it were able to get its profit margins back to last year's level, Macy's could boost its cash flow because if you look at its operating cash flow, which is $2.2 billion in the past 12 months, just a year ago, it was $2.7 billion. So there's definitely some opportunity just in doing the retail basis a little bit better. And Macy's is also likely to bring in a lot of cash from selling off real estate, either real estate in stores where it doesn't want to operate a store anymore, or in some cases it could be really large stores in urban areas like New York, Chicago, and San Francisco, where the stores are so massive that you could sell off the upper floors of those stores, bring in a lot of money, and still keep most of the sales because you'd have a lot of space left. So Macy's is actually working with a real estate company to identify potential deals both for these flagship stores in those three cities I mentioned, as well as a few other stores. And while those proceeds might get distributed through buybacks rather than dividends, as the faster Macy's can reduce its share count, the less it has to pay out in dividends for any given dividend rate, which means it can basically raise its payout faster.
Yeah, on a per share basis. Yeah.
Yeah, exactly.
So for foolish investors, you make a lot of great points. What's the bottom line, the conclusion that foolish investors, just the listeners can go to check out, do their own research, but that you want them to know?
Yeah, so I think the main takeaway here is that Macy's has suddenly become a high-yielding stock with a 3.7% dividend yield. And the payout ratio remains quite modest. And beyond that, Macy's profitability should improve going forward due to its cost cuts, attempts to sell off real estate. And that leaves a lot of room for dividend growth in the future.
Awesome. Well, thank you for your thoughts. And I can't thank you enough again for filling in for Vince, Adam.
You're very welcome.
Have a great day. That is it for us fools. If you are a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. As always, people on this program may have interests in the stocks they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear. For Adam Levine Weinberg, I am Sean O'Reilly. Thanks for listening, and Fool on.